Welcome to Money Life Invest. Today I'm going to talk to you about is there any risk in index fund? Because during 2019 interview with Michael Burry, he echoed a sentiment that according to him, the passive funds such as index funds are in a bubble territory. So I made a video last time saying that, you know, how a novice or a beginner investor should, invest, where I basically suggested what Eugene Fama said that you should just buy and hold a passive index fund and then forget about it. Now, now, when you look at these type of interviews, even though it happened in 2019, um, one should be thinking, does it does it have any risk to your investing philosophy, right? So I just want to analyze this and you know uh, see see what Michael Burry had to say is still true, because even though he said in 2019, does it still hold true in 2022? So with that, let's get started. So so just to give you context, this was an interview by Bloomberg with Michael Burry. Michael Burry was known for his famous Big Shot in 2008, where he predicted this subprime mortgages, and then he thinks in this 2019 interview that index, passive indexes are in a bubble territory. So so in that interview, if I have to summarize, there are three takeaways. So what he said was passive investing tends to distort the price of individual stocks as we buy everything in a fixed ratio without considering the value of each stock. So what does that mean? So basically what he is saying is, think about it. Let's say like if you're an investor in India, you're going to buy a Sensex or Nifty 50 index, right? Say, right? Or if you're in Japan, Nikkei, right? Like or if you're in Hong Kong, you buy Hang Seng. Or if you're in the US, you buy Dow Jones, Russell, or like S&P 500 or total market index. Or if you're in Canada, like me, you'll buy like a TSX composite, right? When you buy these indexes, you really don't worry about the fundamentals of those stocks that are within that index, right? You just buy the index, dollar cost average, you forget about it, right? And you're hoping that index will mimic the actual index, and then if that index makes like X%, and you would do the same, therefore your risk is less because you're more diversified, because you're investing in a basket of stocks, right? but but you are not, you don't go about assessing, okay, in this index, oh, there are these two stocks, their fundamentals are not good, therefore I shouldn't buy it. You don't do it, right? So so what he thinks is, by buying those, you're buying massive, you're buying these index like in a massive manner. So therefore you're not thinking about these underlying fundamentals, so therefore you distort the price of the individual stocks. Secondly, he thinks that, let's say like if you're investing in a small cap index, uh, you you're buying, basically you buy it, and then let's say according to him, if you're in a bubble territory, the passive index fund market should be larger than the active fund. So therefore, like if everyone sells that small cap index fund, there won't be enough uh, buyers but there will be more sellers. Therefore, the price of the small cap fund would crash, which would cause a massive liquidity crisis, right? And then thirdly, he thinks some of these passive funds has like complex strategies, such as like options or derivatives. So you might have seen there are some levered ETFs. What they do is, for example, if you buy S&P 500, what they do is, let's if the S&P 500 goes like one time, they will be going three time on the upside. And if it goes like one time down, they might go like three time down. So it's kind of like leverage. So it's kind of like you want to maximize your profit, but there is downside risk is a lot. So basically, what he's saying is, so think about in a massive correction situation. Since they are levered, they will go like massively. Therefore, they will be causing more money losses or more volatility, right? So now, if you even though he said all of this in 2019, right now at the time of making this video, we are in 2022. Does it still pose any risk to an average investor who's investing in this in the index funds, right? Um, and do I think our index fund in bubble territory? Answer is no. Why? Simply because I made this data table. Basically, here I'm collecting the passive fund market share versus active fund market share across various countries. So to begin with, as I live in Canada, I started with Canada. So in Canada for 2021, the passive fund market share is 14.5% versus active fund is 85.5. So as you can see it, active fund market share outpace passive fund by almost like 70%, right? So there is a huge gap between active versus passive fund. So clearly what Michael Berry's theory doesn't hold good in Canada. However, Canada is very small when compared to the entire world market, right? So therefore we need to look at other markets and see, does does his assertion still hold good for rest of the world. So with that, US market, for US, for 2021, the passive fund market share is 42% versus active fund market share is 58%. So there is a 16% gap, but now you can see why Michael is worried, because the gap between passive and active fund is very, very narrow, 16%, right? Now, world market excluding North America in 2021, the passive fund market share is 20% versus active fund market share is 80%. So there is a clear leader here in world market excluding North America. Like active fund really outpaced the passive funds like almost like 60%, right? So it's like three times. And finally, this is the most critical part. So if you think about the entire world, as of 2021, the passive fund market share is 31% and active fund market share is 69%. So again, here there's two times difference between passive and active funds. So clearly, active fund is more compared uh, to passive fund. So what can you conclude? So it can be clearly seen from above data that active funds have a larger market share worldwide compared to passive fund. Therefore, by investing in passive funds, you cannot distort the price of the stock, right? Because it should be the case where the passive fund market share is more, and then then one can say that yes, now if you keep on investing in passive fund, you're distorting the price of the stock. But clearly, as of 2021, that's not the case. Similarly, even if everyone tried to sell the small cap in a fund, it won't cause the small cap index to crash, or the small cap company to crash, because again the passive fund market share is smaller than the active fund, right? And because you won't be in a situation where there is more seller compared to less buyer, right? It's kind of balancing it out. But since the situation here is the active funds are more so than passive fund, therefore one should expect there will be a balancing act, right? So, and finally, the passive fund, if you read Morningstar, they typically exclude all these complex strategy from it. So like the typical index fund that you and me invest usually doesn't involve any leveraged or inverse strategy, like three times S&P 500, or downside like three times. They don't involve such. It's simple one-to-one mapping of the index, right? If index goes X%, you get the X%. As simple as that. So therefore his assertion of having a complex strategy will further trigger more losses. I don't see that as happening for the passive funds. Now, if so now even though he said these things in 2019, and then he also made it clear at that time that he's not sure when that bubble will happen. um, we are in 2022, and these data are for 2021, and you can clearly see there is a big wide gap between passive versus active fund, where active funds are like larger than passive funds, except for in US, the gap is small. So if we have to argue, if you have to take Michael's case and say that, okay, yeah, he already told that he doesn't know the timeline, but but if for that to happen, this trend has to keep continuing. Meaning, you can see clearly in last decade or so, the passive market has exploded quite a bit across the board. And And if Michael theory has to be true, that trend has to keep going for next foreseeable future, until a point where passive fund overtakes the active fund. But we all know nobody has a crystal ball. Nobody can predict how these markets are going to work, and nobody and as Eugene Fama says, the past performance cannot be true in the future. So therefore, like even though those passive fund market has been expanding, there is an equal chance it it may hit plateau and stay there forever. However, there is a point to what Michael has to say. So for a short term, as of next few years down the line, I don't see any issue in passive index fund in index fund investing strategy. But in the long run, one should watch out, and then reassess as it goes. But clearly, as a novice investor, or as a beginner, you shouldn't be worried about all these investing gurus coming out and making their prediction. There were like a lot of predictions out there. So you just, as Eugene Fama say, just buy it and hold it and forget about it. You should be fine. Um, so so yeah, so in summary, I don't see any problem in the index fund market. Mr. Burry's assertions as of 2022 still not there yet. So you should be fine investing in index fund. So thanks a lot for watching this video. If you like this video, please hit that like button and subscribe to my channel. Um, Please add any comments for any video that you want me to do. I would be more than willing to do it. Thanks a lot and happy investing. See you next time. Thank you.